There will be a tipping point, though, because if the economy becomes unstable and people start to hold their hands, or if confidence declines and businesses start to slow down, the economy could reach a standstill. No one wants the economy to reach a standstill because a recession would force the government to undo everything. I do believe that the United States has a strategic advantage in holding commodities that have the potential to increase in value because it alters how markets view the U.S. deficit in the long run. For example, if Bitcoin is increasing, the U.S. will hold 1 million of it for 20 years, which could partially offset the deficit. The U.S. government, well, the people who work there today are very smart and know exactly how to deal with these various types of economic impacts that we're going to see from tariffs, trade, and much more. Today, Tom Lee is giving us a very new perspective to show us how the U.S. government can basically offset recessions or times of economic turbulence by holding cryptocurrencies. Yes, XRP is definitely part of this strategic reserve. In my opinion, this is an extremely innovative idea that isn't being discussed much at the moment, and many people will not adequately prepare because, if you start purchasing XRP and other cryptocurrencies now, they will increase in value significantly if the U.S. government is actually shifting a lot of assets into those same asset classes during an uncertain economic period. And this is going to be a very fantastic event. This has indeed happened before during quantitative easing, and because a lot more individuals are now able to really accumulate these assets, I believe that this will continue in future market cycles. The U.S. government, Wall Street, and bankers alone are worth trillions of dollars. In addition to all of that, there are a lot of new retail purchasers who will be gaining access to these assets for the first time. So yes, we have some very fantastic topics to discuss today. Press the like button so that everyone can see it and listen to Tom Lee's thoughts. Following the election, there was a lot of excitement because they saw a pro-business administration, a cabinet full of people who appeared to be market-friendly, and what they perceived to be a Trump put, which would protect stock markets from declines. And I believe that persisted for the majority of this year's beginning. It is now clear that tariffs and their potential impact on the economy have made firms and consumers a little more uneasy. The economy is slowing down. Additionally, policies like DOGE, which have significantly reduced federal investment, and some of these initiatives like USAID, may be contributing to the economy's overall weakening. Investors are now questioning if Trump's plans are beneficial to the markets, and for that reason, a lot of stocks have been under pressure. Respondents to the University of Michigan and Conference Board consumer confidence polls cited tariffs and the associated uncertainty as a greater worry than inflation. Many businesses have expressed in the regional Fed polls that they are very uncertain about whether they will be able to pass on price increases in the event of tariffs. Furthermore, remarks regarding tariffs are at 7-year highs when examining earnings transcripts for the S&P 500 and the larger Russell 3000. There is obviously a great deal of ambiguity, and people naturally slow down when they are apprehensive. There will be a tipping point, though, as the economy runs the risk of stalling if consumers get uneasy and wait on their hands, or if confidence declines and businesses restrict their growth. Nobody wants the economy to slow down because a recession will force the administration to reverse all of its efforts because, as you may know, a recession necessitates fiscal expansion, which means spending a lot of money and avoiding austerity. In a similar vein, the Fed wants to prevent stall speed because it must immediately enter easy money rather than worrying about inflation and full employment when employment begins to decline. This implies that a put naturally exists at a particular level. Any policy will have distributional effects. Thus, it makes sense, in my opinion, that if DOGE wishes to cut federal waste, it would inevitably result in fewer federal jobs. Is this inevitably hurting the economy? That is the issue we do not yet have the answer to. We are aware that government spending generally outstrips private sector spending. To put it another way, government expenditure basically competes with private sector spending in an economy. Therefore, cutting back on the government sector is redistributing funds to what should be a higher rate of return on investment. Therefore, it ought to benefit GDP. However, as you point out, there will be unemployment in areas where DOGE cuts are implemented. Globalization and this are not all that dissimilar. In the 1980s and 1990s, which in fact resulted in the loss of industrial jobs in numerous U.S. states, and I believe DOGE is somewhat comparable. Therefore, I don't believe that U.S. growth stagnated during the 1980s and 1990s. Rather, I believe it improved. In the end, I believe DOGE will harm some areas, but it will most likely benefit the economy. Many FOMC members are simply unsure of the implications of tariffs and the new policies, as you can see from the Fed minutes and the conversations at these sessions. They acknowledge that it has caused short-term inflationary pressures, but they are unsure of the long-term effects, which could impede the economy. The Fed's decision, in my opinion, should be put on hold until they have visibility. The Fed understands that the labor market isn't causing inflationary pressures, but the current inflation environment isn't necessarily persuading the market that inflation is about to moderate again, particularly with tariffs. As a result, the market sees the Fed's current pause as a hawkish pause. If the labor market starts to improve, I believe that the entire discussion will shift. Returning to Doge, the employment data for February or March may be the first to highlight the detrimental consequences of these terminations and layoffs, and the Fed will be pulled off the sidelines if that is the case. The Fed must so adopt a more dovish stance. Yes, I do believe that the Fed will lower interest rates if the labor market improves. As part of that, the Fed has admitted that a large portion of the inflation we observed last year was statistically lagged inflation, things like shelter, Compared to official measurements like vehicle insurance, which simply follow market movement, market-based metrics of shelter are exhibiting far lower inflation. Markets aren't convinced that inflation is lower, therefore, I would say the Fed itself admits it, even if they could lose the public relations battle there. Measures based on the market indicate that inflation is considerably lower. Therefore, I believe they would cut. The employment index component of the February ISM manufacturing report, which was released today, was 47. You're already under 50. Then. Numerous regional surveys already indicate that capital expenditure plans are on hold and employment may possibly be slowing down. As a result, the economy appears to be slowing due to uncertainty. Furthermore, if Friday's February jobs report shows fewer than 100,000 jobs, I believe the Fed will notice a sharp shift in the labor market's momentum and will need to respond because once more, if the economy stalls and a recession begins, the Fed must take emergency measures, which entails sharp cuts rather than a cycle of cuts. A June cut, in my opinion, has a 64% chance, a 75% chance for July, and a mere 28% chance for May. The likelihood of a May cut increases to 100% if the February jobs report is weak and the number of unemployment claims keeps rising. I now believe that there would be no rate reduction at all in the second quarter of 2025. The worsening of the labor market and its impact on the economy, however, was something I was not fully accounting for. You see, during a phase of quantitative easing, businesses are able to invest more money, they have more liquidity, and banks are essentially receiving cash infusions. Having said that, there is no denying that it has a cascading effect on the economy, generating additional jobs and ensuring that the unemployment rate is reduced. Additionally, you can clearly notice a pattern over the past 2 to 3 months from the measurements that are displayed on the screen. I'm maintaining a hawkish stance on that one, just like the Fed is, since unemployment rates have been rising and we're really having another data day today that will have a huge impact on the market's future.